Hello and welcome to StudyIQ. In this session, we will discuss about the revival of microfinance institutions in India. Microfinance institutions. First of all, let us see what is a microfinance institution. Microfinance institutions are those organizations which offer credit to low income groups in the society. So, the credit is given to low income group. Or we can say economically marginalized. So, low income group or economically marginalized group. So, what is the relevance? Since this finance or loans are provided to low income group, it means that the bridge between the formal financial institutions and the lower income group are bridged. So now let us see how this microfinance institutions give this loan or credit to low income groups. So what this microfinance institutions does is that they will collect funds from commercial banks or from other institutions. So they take funds from commercial banks or other institutions and then they give it to the low income group. In the year 2010, government had appointed a committee to study about the microfinance institutions in India and the scope of such institutions. And the committee was chaired by Y.H. Mallegam. So let us quickly see what were the recommendations of this committee. Y.H. Mallegam committee. The first recommendation of this committee was that microfinance institutions should provide loans to weaker sessions whose annual income is less than 50,000. So, the first recommendation, annual income less than 50,000. But the RBI said that the cap will be 60,000. So, RBI decided it to be 60,000. The second recommendation of this committee was that the ceiling on interest for such loans should be 24%. But RBI said it should be 26%. Remember that these are the recommendations of Y.H. Mallegam committee. This is not exactly what is in the present scenario, but these are the recommendations of Mallegam committee. And when we talk about microfinance institutions, this committee should come into your mind, and this is a very important committee. Maybe if you are giving a descriptive type answer on microfinance institutions, it would be very good if you can include the name of this committee. The examiner would feel that you have in-depth knowledge about the subject and will fetch you more marks. So, remember the name Y.H. Mallegam. The third recommendation of this committee was that there should be a separate set of rules for microfinance institutions. So, set of rules, namely MFI, NBFC. So, a separate set of rules should be framed for this microfinance institutions. It means that it should be governed differently. So, commercial banks should have different set of rules, and when it comes to microfinance institutions, since their purpose itself is different. See, the purpose of microfinance institutions are to give credit to lower income group. So, the purpose itself is different, the focus is different, so it should also have a separate set of rules, and this was accepted by the government. This recommendation was accepted. The next and the most important recommendation of this committee was that those commercial banks who are lending to microfinance institutions, we have already said that from where will this microfinance institutions collect the fund? We said it's from commercial banks or from other financial institutions. So, those commercial banks which lend to this microfinance institutions, that amount of loan should be considered as the priority sector lending of those commercial banks. So, you know what is priority sector lending? Priority sector lending means out of the total lending of a commercial bank, the bank is supposed to give a particular percentage of total lending or total credit to priority sector in the economy. Who are the priority sectors? Priority sector means agriculture, education, export, housing, etc. Micro, small, medium entrepreneurs, they are all considered as the priority sector in an economy. So, according to this committee recommendation, the committee recommended that those commercial banks who lend to the microfinance institutions, that portion of their lending should be considered as priority sector lending, because the ultimate purpose of the microfinance institutions are to provide credit or loan to lower sessions or economically backward sessions. So, ultimately these funds go to priority sectors. So the funds of the commercial banks or that lending part of the commercial banks should be included in the priority sector lending of that bank. So these were the recommendations of Y.H. Mallegam committee regarding the microfinance institutions in India. So recently microfinance institutions were in the news and it has become an important current affair. What is the reason for that? The reason was that the asset quality of the microfinance institutions and small finance banks are improving. So asset quality is improving. So what is meant by asset quality? Let us first see what is an asset. When you take a balance sheet, what happens? There is two sides of a balance sheet. One is liability and we have the assets also. So assets and liabilities, and in case of a balance sheet, the assets and the liabilities should tally, which means that assets should be equal to the liabilities of that particular company. So when it comes to a bank or when it comes to a financial institution, debtors or loans are in the asset side. So debtors or loans are considered as assets because it is going to earn income for the bank. So they are assets for a bank. So what is meant by asset quality? The quality of an asset is considered with regard to the credit risk associated with that particular loan. So the credit risk is taken into consideration while we analyze the asset quality. So when we say there is a good amount of asset quality or when we say it is a qualitative asset, what does it mean? It means that there is lower credit risk associated with that asset. So if some loans have lower risk of repayment or lower credit risk, we say that it has some quality or the asset quality is high. And in case of loans wherein the repayment is due or there is more risk associated with loans, we say the asset quality is low. So when we say that the asset quality of the microfinance institutions and small finance banks are improving, it means that there is high asset quality with regard to these banks. What does this mean? It means that there is lesser credit risk related to these banks and there are lesser repayments which are due in these banks. So when we say microfinance institutions, you must understand that this includes small finance banks, non-bank microfinance institutions, non-bank microfinance institutions. You all know that demonetization has affected our financial institutions. So as a result of demonetization, the borrower behavior have changed. So as a result of the demonetization, the delinquencies in the financial industry has increased. So what is meant by delinquencies? So is it the same as default? No, there is a difference between delinquencies and default. Let us see what it is. So we say that there is a delinquency when there is a default in single scheduled payment. So if a single payment is default, we call it as delinquency. So as a result of demonetization, delinquencies in the financial institutions has increased. But the microfinance institutions were able to overcome this challenge. So they were able to overcome this challenge of delinquencies. Why? Because they had a very strong credit profile. One is the credit profile and the second reason, healthy capitalization. One reason for credit profile is increased awareness among the customers of the microfinance institution. It means that the microfinance institutions not only provide loans to the low income group, but they also provide financial literacy. So the customers are provided with financial literacy. That is one reason they do not make default in repayments. And one major challenge or drawback associated with this is that during the time of demonetization, there was high usage of digitalization and technology. But in case of the customers of microfinance institutions, the nature of customers are that they are low income group. So there is lesser penetration of digital technology into those groups. So that was one major challenge faced by the microfinance institutions during the time of demonetization. Now let us see what is the relevance of microfinance institutions in an economy like Indian economy. relevance. First of all, microfinance institutions helps in financial inclusion. So financial inclusion is possible. What is meant by financial inclusion? Financial inclusion means that more people are entering into the formal financial sector. That means more people are utilizing the banks or financial institutions which are in the formal sector of the economy. So more people coming into formal financial sector. So we said that microfinance institutions give institutional credit to lower income group. Earlier, these people did not have access to formal credit. So they may be small and marginalized farmers, or they may be small industrialists or micro, small or medium entrepreneurs. So they did not have access to formal credit. So with the help of microfinance institutions, now they have more access to formal credit. One thing you must remember is that this microfinance institutions are under the oversight of RBI. So which means that RBI has a supervisory function over the microfinance institutions. So this will provide more transparency, and also this makes the microfinance institutions more formalized. Secondly, it banks the unbanked. With more number of microfinance institutions, especially in the rural areas, what happens? The banking services, not only the credit but other banking services like savings, deposits, money transfer, etc. becomes accessible to all people. So banking services becomes accessible, and those people who are unbanked now can utilize the facilities of a formal bank. Thirdly, it helps in the socio-economic development. Let us see how. Socio and economic, let us take it as two terms. So socio-development means the development in the standard of living. So now they have access to banking facilities. So their life becomes more easier. They can avail banking facilities. They can save their money. They can use bank for transferring funds, etc. They will receive the subsidies through banking. So the standard of living increases. So it has a social impact. Coming to the economic side, it provides credit to poor households. So poor households get credit, or low income group get credit. Now they have the capital to do business or to invest in agriculture. So they have credit facilities. Also it is formal credit, which means that their income will increase. So income will increase. As the income of a household in an economy increases, what will be the macroeconomic effect? So when many households have more income, or when there is increased income with many households, what happens? The per capita income of the country increases. The production increases, thereby the GDP also increases. This leads to economic development of a country itself. It also makes the financial services accessible for the low income group. We said that at the beginning of this discussion, we said that microfinance institutions focuses on low income group or economically backward. So the financial services becomes accessible for them. Again, we said another goal of this microfinance institutions is to provide financial literacy. So they not only provide credit, but they also provide awareness or financial literacy to the customers. So providing financial literacy will help them to properly utilize the financial resources of the economy or of these banks. Another thing you should note here is that with financial literacy, these poor households will be aware of the already existing financial services. See, in India, what is a major problem? There are enough schemes, or there are enough programs and policies from the side of government and various stakeholders to improve the condition of poor and low income group. But the thing is, they are not aware about it. So they do not know what all services are available to them. So by providing financial literacy, they will come to know what all services are available to them, so they can properly utilize these resources. Another important feature of this microfinance institutions is that they provide loans to the low income group, which includes mainly self-help groups, women and rural households. So these are considered to be weaker sections in a society. Self-help groups. So empowerment of self-help groups is possible. Again, women is considered to be weaker section in the society. So empowerment of women, rural household, they will become competent enough. So The weaker sessions are provided credit through the microfinance institutions and they will be strengthened. Another noticeable feature is that these microfinance institutions at times provide not only credit but also training, especially to the first time customers. So training here means financial literacy and also awareness about microfinance products. So what all products are available or what all types of loans are available under microfinancial institutions. These awareness is also given to the customers. So more awareness, they will utilize the funds properly. So see, after seeing all the relevance or importance of this microfinance institutions, we understand that for a country like India, microfinancial institutions play a vital role in bringing financial inclusion in the economy and banking the unbanked section in the economy. So now let us see what is the development that has taken place in the microfinance institutions since they have started functioning. So let us go through the development. First of all, the microfinance institutions network shows a reasonably good percentage of growth year after year. It means that the network is growing year after year. There are more and more number of microfinance institutions coming into the economy year after year. Secondly, there has been an emergence of NBFC MFI. What is NBFC MFI? NBFC refers to non-banking financial companies. So many NBFCs have emerged into microfinance institutions. Thirdly, the formation of self-regulatory organization. What is self-regulatory organization? Self-regulatory organization means that organization which regulates the credit or which is responsible for lowering the credit risk. So self-regulatory organization has also been emerged. Again, we will also see the transformation of many MFIs or microfinance institutions into universal banks as well as small finance banks. So the transformation of MFIs into universal banks and small finance banks. Again, see, the microfinance institutions in India have almost 45 million customers and microfinance institutions have given almost 1 lakh crore loan and also has employed around 1.2 lakh people. So see the relevance, how important it is. So 45 million customers are availing the services of microfinance institutions. So it means 45 million people are now in the formal financial sector. The financial inclusion in the economy has increased. So 45 million people have access to formal credit or formal banking services now. Again, 1 lakh crore loan. So earlier these people were dependent on the money lenders. So 1 lakh crore more formal loan or credit has been added. Again 1.2 lakh employment. So this itself shows how important is microfinance institutions in the economy. But there are also certain challenges associated with this microfinance institutions. So let us see what are the challenges this MFIs face. The first risk is that there is a risk in the near-term profitability. So near-term profitability, which means that at present or in the short run, they have lesser profit or the profitability of these banks are less in the short term or at present. What are the reasons for that? So they have high cost in acquiring funds or credit costs are high. Credit costs are high. Again, they have to keep CRR, SLR, etc. So initially this will have an impact on the profitability of the microfinance institutions. But in the long run this will be rectified. But we are discussing about the challenges. So one challenge is the near-term profitability of this microfinance institutions. Another one is with regard to the operating expenses. Another challenge is with regard to building liability franchise and garnering retail deposits. So liability franchise and retail deposits. So these are the challenges. Even though there are certain challenges associated with the MFIs, there is always a greater prospects for this institutions. Let us see what are the prospects or future expectations from this institutions. See, we have said that the credit cost of these institutions are high for the time being. But what happens in the long run is that the credit cost will come down substantially. So the credit cost will decrease and this will earn them more profits, or the profitability will also increase. See, you must understand here that MFIs have more presence in rural areas, or there are more microfinance institutions in the rural areas of the country. So the loans are provided mainly to lower income group. So there would be lesser EMI also. So rural areas, lesser EMI, and also weekly collections. So this will reduce the cost of this credit. So this will also be a future prospect for them. Again, you must remember that there is greater demand for loans from MFIs. Why? Because they are providing loans to lower income group and MFIs are more accessible for them. So what happens? There will be more demand for credit from the microfinance institutions. So when there is demand for a commodity, in general economics, when there is increased demand, what will happen? There is always a chance that it will succeed, or there will be more production. In case of an industry, when there is more demand for that commodity, what happens? The production will also increase because there is more demand. So there is no question of quantity. So as there is more demand for credit from microfinance institutions, there is always a prospect of these institutions growing. So in the medium term to the long term, what would happen? There will be more operational efficiency. Operational efficiency will be high. Plus the cost of raising funds will come down. Cost of funds would come down. Also, the credit cost also would be stabilized. So all this will lead to increased profit for this MFIs. So profit of the MFIs will increase in the medium term to the long term.